Starting the recording. All right, so simple things about options trading that um, that I think get a little overcomplicated and maybe written a little too lengthily for people to get through with ease. So here's my little tutorial, real quick. First thing to know about options is the whole point of options trading is to essentially trade risk. Futures are basically the same kind of thing. So the idea is like one individual, the seller of an option, is trying to reduce their risk by selling a contract to the buyer, who is basically buying the risk, and you generally have an exchange of high risk, high reward versus low risk, low reward, and that's what both individuals involved are trying to aim for. So you have two types of options contracts. You have the call and you have the put. I've got them color coded in an appropriate way here, so you really understand. Like, a call is essentially about buying or expecting the stock to go up, and a put is about selling and expecting the stock to go down. In the case of the contract seller, the seller of the contract, right, for a call contract, they have sold the right for the buyer to buy 100 shares of the stock from them at what is known as a strike price by the expiration date. Simultaneously, the buyer has bought the right to buy 100 shares from the seller at that strike price before the expiration date. So one thing to be aware of is, because it's 100 shares at a time, what you'll get is the contract price is represented as a per share basis, but you're gonna be paying 100 times that when you buy a contract, or you're gonna get 100 times that when you sell a contract. So it'll be like, in dollars and cents, you just need to move the decimal point over to know exactly what kind of money you're getting or risking. So the put is a little bit more difficult to understand. So I'll go over that after I go through a quick example with tastytrade. By the way, I put it in the comments here, or sorry, in the chat here on Discord, and I will be putting it in the description of the video. I have a ref link for tastytrade, so if anyone wants to, anyone who doesn't already have a tastytrade account, if they want to thank me for this tutorial, a great thanks would be signing up for a tastytrade account. If they're going to throw that money out there anyway, if they put $5,000 in their account and maintain like over $5,000 in their account, and maintain over $5,000 in their account for the next 6 months, then I get $250 for referring them. So it'd be great to get that kind of a thanks, if there's no other way you feel like thanking me. Okay, so that being said, what we have here is the it's a whole setup of what you're going to look at for buying or selling your options. You see, you have the expiration dates here. This is the SPY, basically an S&P 500 ETF, a very popular one, very lucrative in terms of having lots and lots of volatility. And here you have the expiration dates, and in the middle here you see how many days until expiration. And then if we open one of them up, August 5th, here we have an example of one that I've set up to buy a contract with a $550 strike price, and down here we have like what the cost would be in cents, as I was referring to before, right? So like 15 cents means I'd be paying $15 for that. For whatever reason, the app's not really putting a bunch of data through during the off hours, so we're not really getting any information about the buy and sell price, unfortunately, or the bids and asks prices out there. But there are bids and asks on the market currently. They just don't quite move around or get realized until the market opens up again. And anyway, so we've got so say I purchase this for what'll probably be more likely, say something upwards of like say $3.50 per share to be in the contract. That means I'm paying $315 to purchase that one contract, and to visualize what it looks like for possible success for me is you have here the strike price being $550. If the stock itself moves up, say to 580, that's a difference of that's a difference of $30 in the stock value, right? And so as long as I paid less than 30 times 100, so less than $3,000, if it goes up that high, by August, or the expiration date in August, 15 days from now, if it goes up that high, well then I can execute the contract by forcing, like basically execute the contract, thus letting me buy 100 shares at $550 per share, and then immediately selling on the market for $580 per share, making up that difference, right? So in summary, I paid in this hypothetical, I paid $315 for something that ended up being valued at $3,000. So that's a good little chunk of change, all based on the difference from the strike price that was agreed to, and this initial price that I paid is considered like your premium essentially. Like if it was at the immediate strike, like at the exact at the money, meaning at the strike price, and if it cost me $315 while it was right there and it would have no inherent value, that would be all of what's considered premium in the option contract. Okay, any questions so far for clarification?
Nope.
All right. All right, then we'll go to, what was it? Right back here. Too many tabs. There we go. Okay, and so also something to note, if you see DTE, that just means days till expiration for short. It's a common thing that will come up in conversation. So the put contract is in an inversion of the call contract, in that the contract seller, who's going to get that premium money, right? They sell the right for the buyer, who's paying for the premium money, or basically paying that premium money, to sell 100 shares to them at a given strike price. So we're agreeing to a strike price in which the seller will buy the 100 shares from the buyer who has bought the right to sell. Just try not to get too caught up in the dyslexic errors along the way here, but it can get a little confusing, I know. So that's why I've also got this color coded. So the buyer bought the right to sell 100 shares to the seller at that given strike price before the expiration date. Also, to just make clear, if you reach your expiration date and the contract isn't worth anything, right, because it's not in the money, well, then nothing gets executed Nothing ends up transpiring. The buyer essentially loses the money, and the seller makes the money. Oh, something to also note is that a lot of times the the whole concept of like the purpose behind this, right, is more of a thought, like say the seller of the call contract had maybe bought their shares at say 540, and they sell the contract out of the money to the buyer for like for a little premium, um, and then the money the value of the stock goes up to say 580 like we said before in the hypothetical, right? Well, if the seller of the contract paid $540 for it, and they valued it at 550, right? That's a good chunk of change to say I'm guaranteeing myself that little boost if the value of it goes up like at all. So that's the whole reason why this is considered selling the risk, is because the seller not only is saying, okay, I'm agreeing to get what is already out of the money, what is already like gonna be a profit for me, that essentially is guaranteed so long as there's some value relative to what they're selling. And then when they sell that contract, they get their premium on top of it. So it's like you get a more certain chance of being able to make a profit based on your 100 shares, as the seller. The seller is also making a very small gain by comparison to the fact that their position is covered, right? So their covered position means that they're holding on to that 540 shares in the first place, which, or sorry, that 100 shares that cost them 540 in the first place. So it's like they're already holding on to a huge chunk of money in order to be able to make this play in the first place. So they're making a tiny gain with much less risk. While, like as described before, the buyer, they're paying what relatively is very, very small amount, that has a great chance of fluctuating to extreme values, depending on what the position happens to be. Um, let's see. Yeah, and by my recollection, actually 300 would be very, very cheap for this. I think, given like how you can see the bell curve here, that kind of suggests the likelihood of such a thing being maybe a bit more out, as like someone might expect a good chance that it could reach 580, probabilistically. So they would sell such a contract for probably over 1,000, maybe even over 2,000. But it constantly changes and fluctuates. So that's how you play the game. By the way, I should make sure, especially, I don't know why I didn't put it here. Let me make it absolutely clear. So my bad for not making this already. Not. Oh, whoops. What I meant was. Not a financial advisor whoops. Oh no, why would you do that? Okay. Not financial advice. So, just so we're clear, this is all personal opinions and educational wisdom combined on the whole concept. Nowhere in here. If I make any statement about what my own interests are and positions are, none of it is financial advice whatsoever. Just covering the disclaimer. Okay, so let me see here. Where else was I wanting to go? Okay, so yeah, so the put contract, you can see, I could probably, let's see, do we want to, there. So say, yeah, there we go. Instead of a buy contract, let's delete that leg. Say we buy a, actually, that is showing, wait, delete. There we go. So see, it's green, it means I'm buying. But buying a put on the right side here with a 548 strike price, that is indicating that by the end of the 15 days, I'm hoping that the value goes down. So like, because I have bought a right to sell at 548, so if it goes down further, like 545 by August, and the difference is less than my premium cost. See, it's not even gonna. It's because it started at a really low number because there's no data. Like say it's like because we are talking. How do we go beneath there? Yeah. Well, it's not usually more or less the difference of the spread. Actually, I should say there is often a difference where depending on market sentiments, people could be buying more puts versus buying more calls, and then that side happens to be what the market you can kind of see as a sentiment. Whether or not people are thinking generally that it's going to go up and down, up or down next. But so say if it goes down and I have the right to sell 100 shares at 548, then I immediately get that ability, if I execute it, to buy the 100 shares at the lower value, say it's 545, and then execute the contract by selling to the seller at 548 per share of 100 shares. And this here, if I bought it and it said two, just to keep consistent, that's actually $200 that I would be paying for buying that put contract. And let's go with. All right. Now from here, okay, I want to explain the FINRA complete trash. Oh, sorry, wait, before we get to that. To freely trade your option strategies, and I should maybe explain actually first. What we have is a bunch of interesting kinds of strategies that people do where it gets a little complicated, but you start to think about it, it makes sense. So you have, like, say, in this case, a long vertical here, where what this is it's indicating the selling of a contract and the buying of a contract with a difference between them. You could have a strike difference, or you could also have a calendar difference where it's like you're selling something that's got a later expiration date, and so it's got more premium value to it. But then if you don't pull it all back before the if you don't pull it all back before the what is it called, the expiration date of the one you bought, then you're left hanging with this empty sale where you don't have it covered in any way. In this case, that difference there is what you're actually risking in this play. The worst case scenario being that you, let's see, actually, the worst case scenario, you sell this, you buy this, this is going to be worth less. And so the worst case is you're buying that difference in their premiums, or their for the contracts, or the cost of the contracts. And so what this does is it kind of offsets as what you would normally be doing is just buying the premium for the 550 at whatever that cost is, and then you could lower the cost by selling at the higher value. But that also means that if the value of the stock goes through the roof, right? It goes to like 560. Once you're really past 554, the inherent value of the stock ends up being this difference in hundreds in 100 shares worth, right? So 554 minus 550, that's $400 maximum, and you're probably not going to even get exactly that much, but that'd be like a $400 profit maximum that you could have if both of these were just simultaneously executed. Um, like both by the buyer of your sale and then you executing the contract that you bought. Does that make sense, Lawrence? I'll make sure I actually explain this well. You there, buddy? You're muted, just FYI. Oh, you unmuted and then muted again.
So I'm muted?
Oh, there we go.
Already
I can
muted.
hear you. I can hear you now.
This is the weirdest thing. Oh, okay, there we go. My computer's doing some weird stuff. No, I was just saying that I will definitely have to, like, just visually kind of, like, do it myself too.
Okay.
Just to fully understand the stuff. But yeah, because like all of this stuff is brand new to me, to be honest with you. So, but this is really, really awesome.
Right on.
So I'm just gonna hang back and just listen, and then, um, like the way that I learned is just in stages. So like this is really, really cool. So yeah.
So here, hopefully it'll. So normally, if we were looking at this in real time with the data going through, they would be cool enough to actually show this curve to show when you would be making money versus when you would be losing it. And for some reason, they are not showing that with the vertical spread for some reason. I think it's because the market's closed. So, but this indication of like green across the board, that's not the case at all. You would have like red over here to the left, and then green to the right, and then maxing out at the difference between the sell and the buy order. Well, let me just see if would they show maybe something with a strangle. Still nothing. So strangle is when you buy a position in at the same when you buy a put and a call. It's easier to visualize on the table here. So you buy a put and a call with a little distance between them, so that there's your premium difference that's in total, whatever these cost you. So like, let's say the total of it is $1, right? Whatever that premium value is, you're going to need one of these to overcome the cost of both contracts in the direction it's going. So this is usually the kind of position that you take, either a strangle, or if it's the same strike price, they call that the straddle. And basically the only way you can lose is if the values sort of like stay stagnant and stuck in between or just short of where your total cost for the contracts would not like end up with a net gain for yourself. So if you think like, I don't know which direction it's going to go, but I feel like it's going to go really hard and fast in one direction, then you can buy yourself a strangle or a straddle or a strangle, and feel pretty confident that you're going to make some good gains regardless. of which direction it is. It just needs to go hard and fast. So that's a kind of like complex strategy that you can have. Now, here's where I've learned, but still kind of struggle with other types of things like the iron condor. I'm just not proficient at understanding how to do it, or the jade lizard. So there's two sales: sell of a put, sell of a call, and a buy. You see here now it's starting to kick in the sort of relations you can expect, right? Where, or maybe that's just their default and it's not actually calculating. But let's see. Okay, yeah, see, it's actually moving around. Where here, if you did, it indicates here, and again, I'm not proficient with the jade lizard, so it might actually be malfunctioning right now. But if this indication, if the color indication is right at all, this suggests like the green area is where you would win, so you'd hope that the value would stay stagnant, maybe go down a little, but not go too hard in either direction. And that would be where you would make gains. But same thing goes for every kind of strategy that you have. Like you have a buying version and you have a selling version. So you basically would say you reverse this, and then let's see. Yeah, it likes to change its mind. Like I said, I'm not proficient enough with all of them, but I can at least share what I am knowledgeable about. Butterfly is an interesting one where there we go, like it can get a little complicated, but there you have even another kind of setup where you expect you'll gain if it goes strong in one direction, but lose if it stays stagnant. And then selling. So this is showing a short. So this is suggesting you're selling a butterfly. If you go long, man. So yeah, you shift things around. Don't trust it if it shows like green all the way across, because no position that I've ever discovered is like green no matter what happens. It's just it's got to be like a malfunction allowing for that. But you learning more about this, in fact, a really great resource for learning about all of this is tastytrade. Okay, let me just use this tab. Tastytrade. They're not only a great brokerage, but Tasty Live, Tastytrade. These are really great.
Hi, Scott Sheridan, CEO.
Got it. These are really great resources for learning. They've got some educational playlists to learn all the different strategies, and also to learn their platform. So these guys are great. The main guy, or main founder, I want to say, I could be wrong if there's like some details there, but Tom Sasanoff is just he's the guy who made who first made what was that other one, trade. Man, I'm blanking on it, but there's a really well-known chart, and I want to say brokerage that he started. Yeah, because it didn't quite do this before. Let me just do it fast. Tom Sasanoff. No, wait, it's two F's, I remember. No, wait. Tastytrade. There we go. Sasanoff. Tom Sasanoff. And here we go. His Wikipedia should say. TD Ameritrade bought it, right? Thinkorswim, that's it. He's a major co-founder of Thinkorswim. And that's just one of many resources out there that I find they earn their reputation because they're good. Like you don't always get products out there that are earning reputation just because they're good. Mostly it's like marketing tactics and advertisements. But when you have something that like actually does a really good job and earns its usage by like word of mouth more often, that's the kind of stuff you always want to aim for. And the kind of people that make it happen, they deserve the reputation to keep following them. So that is how I have felt about, or that's how I feel about tastytrade. In essence, my opinion is they're really great as a learning resource and getting some ideas for trades that are safe. Because they've been doing this for a long time and they're very open about advice, and they do studies as well to kind of show what directions things are going to go, in spite of what their personal opinions happen to be. So let's see what else we got. Let me backtrack to the tutorial form. Okay, so to freely trade your options with those option strategies, you're gonna want a margin account with options trading level 3. They're gonna ask you things about where you're at, where you're coming from, and they just want to know that you have enough money, experience, and you are willing to risk. So the key word is speculation, to suggest that you're really just gonna want to try anything, to speculate the market. You're willing to take a lot of risk. Let's see. As for the FINRA garbage laws to be aware of is pattern day trade. There's 2 rules. One of them is pattern day trader. You are considered a pattern day trader if you execute 4 or more day trades within 5 business days. That's stocks or options. Provided that the number of day trades represents more than 6% of the total trades in the margin account for that same 5 business day period. So that basically means you're a pattern day trader if, like, of any 5 business days in a row, you do more than 3 trades. Three trades where you buy and sell the same position the same day. You're allowed to do this as much as you want if your portfolio has more than $25,000 in value. So as a special requirement to day trade. This is classism at its finest, established in 2001, and I hate them so much. I hate them so much for that. FINRA needs to burn, in my opinion. Rule 2, day trading power. Apparently, even if you are okay with your 25K minimum requirement in equity, you are still limited in how much you're allowed to day trade with in a given day. So it depends on what you earned the previous day, or what you had the previous day. So actually, let me just explain with the summary I put down here. So what really happens, you have margin accounts that let you borrow against your shares to play with more cash than you have. 14 or up to like 4 times the value of any stocks, bonds, and ETFs that you buy. So you're kind of borrowing against to play with more money than you actually have. Cash accounts are accounts that have no borrowing whatsoever taking place. In a margin account, your brokerage is going to ignore the special exception that, like, oh, you could day trade fine with less than 25K if you if it's less than 6% of your total trades. No, they're not going to pay attention to that unless something goes wrong and they have to margin call you. they're going to stop you from trading a third or a fourth time within a 5-day business period if they detect you doing that, day trading like that. Your brokerage is going to just keep counting those day trades and keeping score in their system, and then your total. But if your total is 25K or more, they'll still count them, but you will be able to keep going as much as you want. You can only day trade the cash. So this is what I was getting at before with Rule 2. You're only allowed to day trade the cash from the previous day at a given time. So what it means is when you have, say you have say you have $2,000 in your account on the previous by the end of the previous day, $2,000 settles. You are allowed to buy and sell up to $2,000 at a time. So even if you say buy $2,000 worth of a stock on a given day, and a minute later you sell it for $3,000, you're not allowed to buy $3,000 worth of that stock same day. You have to wait for, even though you've got a margin account that accounts for borrowing money, they're going to give you crap. And in the case of most brokerages, like the one I use, not tastytrade but TradeStation, they're going to stop you from being able to use that money that you haven't settled yet, as in being able to day trade it specifically. So you'll get a margin call if you try buying $3,000 worth of stock and selling, say, for $4,000, because you're effectively borrowing money and breaking the second rule of FINRA on how you're allowed to borrow money. It's really stupid. Like, somebody just destroy FINRA, because they should not be allowed to exist with this kind of incompetence. Anyway, so yeah, it's like nobody's allowed to get too rich too quick by compounding everything in one day. As for cash accounts, in a cash account, day trading is not allowed. However, the thing is, FINRA doesn't define a day trade as being something that you just buy and sell with cash. They define a day trade as borrowing from margin to reuse your cash from the same day. And so what this is coming from is, when you sell a position on the same day, or you sell a position at all, your cash is considered settled at the end of the day. So with a margin account, you can keep playing with that money as if you had got your cash settled. But in a cash account, you have to wait till the end of the day for that cash to settle from your sale before you can be able to buy with it again the next day. Also, in a cash account, so it won't count as a day trade, but you can only spend, like, say, up to the total. So in the same case with the $2,000 in a margin account, the $2,000, you can buy $2,000 worth of stock, sell it for $3,000, but then you have to only buy up to $2,000 more in another stock in the same day, and sell for whatever as a day trade. Then that's the limitation with a margin account. But with a cash account, it's like that $2,000, once you've bought it and sold whatever you bought with it, it doesn't come back to you after that. You only get one cycle. So this can sometimes be useful if you want to do something like that's highly low risk and speculative, so you don't have to worry about the counting of the day trades. You can maybe buy, like, say you've got $2,000 in cash, but you're buying a $100 position and selling it and then buying another $100 position and selling it. It's only when you've reached a total of $2,000 worth that you've bought that day that you would have to stop. So for me, it's been better to have a cash account because I'm just so annoyed at the day trade counting and how it's such a ridiculous rule that this gives me a little more freedom until I get to the 25K amount. But what it also does is it prevents me as a cash account. You can't do the spreads that are all perfectly safe otherwise. You can't do these kinds of spreads because there's no margin to handle you covering the positions that you sell. And if you have enough cash that you are covering those positions, cool, but you're also not really increasing your portfolio percentage wise as much as if you were able to borrow from margin just to be able to just show that the difference in these is accounted for and that you're not really risking as much as the whole sale of the contract would be risking. It being if it were uncovered. Whoops. Back to it. Let's see here. And then final lesson I had prepared here is futures. Fun fact, futures are not regulated by FINRA. So none of these trash rules apply to trading futures or even futures options, which is a thing. Unfortunately, I'm not proficient with futures just yet. So that is a thing that's going to have to wait for a bit for me to be able to do that myself. But it is the next thing I'm looking into. That's pretty much the extent of my knowledge up to this point. So I put the link for the doc here, and also a link, as I mentioned before, for my referral, if you guys are up for it. I guess feel free, like this can be like an open forum for a minute. Are there any questions, Lawrence?
Well, I don't have any questions just off the top of my head. Like, but this is great. This is so dope. I'm just figuring it all out and just like I have an individual broker account, believe it or not, but like but it's over at Morgan Stanley, and but I'm actually filling in stuff for the tastytrade.
Oh, okay,
So
cool.
um,
Much appreciated.
yeah, I mean, it just looks more fun to use.
Yeah,
Um,
it's got a lot more tools. The only downside I have found personally with Tasty Trade is that they do a commission basis, but that in a sense is a little bit more integral than the basis that people are doing, where there's like they basically they cut in their little difference between people's buying and selling. So they basically keep a spread in most brokerages that'll be like zero commissions. They have a spread that they'll actually make you trade with them before you can trade with others, so that they're always getting that little tiny bit of value in between people buying and selling. Whereas with Tasty Trade, it's a very set amount, and I recall it doesn't actually go up percentage wise with your options. Or I could be wrong about that. But the thing is that if it's a straight commission, that can be great, but it's horrible if I'm trying to play with small amounts at a time. And being that I don't have 25K yet to throw around, I'm stuck with that. with that being a problem.
yeah, no, this is good stuff, man. It's just kind of gotten me where I'm going to dive in a lot more, and and then kind of like meet you like where you're at, like you know what I mean? Because some of it is foreign, and I'm just like, oh, I get it, but I don't.
Well, yeah.
But
So
it's all good.
that's in part what I was hoping for with this being not just a tutorial. Like I just recited everything that I prepped ahead of time, but
Mhm.
if you want to look at this like real quick right now, like is there a step in this concept that is not quite clear for you? Like here where we've got a call contract,
Mhm.
right? Um, maybe even if you don't mind, it could help to hear what's your idea or concept of of how a call contract works.
Yeah, so I'm actually confused a little bit about um you know uh between the two, like the call and put, but it's not that I'm confused completely. It's just how my brain works. It's like I have to understand all of it in order
Oh
to
yeah,
like actually like kind of flow through it. So
yeah. That's everybody.
and there's no,
That's not a
yeah, I'm
that's
like I'm Jon Snow until until I finally understand. So
well. So would you be okay with walking through it? Like we can get an idea of where you're at.
um I think it'll probably be best to um like send me with homework, and then we like I think having like another, like even if it's just repeat, like it'll be dope because then there'll just be a little bit more interaction,
Okay.
and I'll have like a strong, like more strong question. I have questions, but I have no placement for those questions because I actually did research myself, and I was just like, all right, I just need to just understand where you're at and how you kind of navigate and how you kind of place trades, and then just understand the system a little bit, like watching like how you kind of like go through all the different functions within tasty trade, and then or available options within tasty trade, and then and then take it from there. So that's where I'm at, like so yeah, so I'll just be wasting time just going through it right now.
All right. So I'll put this out as homework then. So if you just keep track of the document here, the options tutorial document, and what I would like is just try going through like each part of this like one step at a time and until you reach a snag, right? What you can do is say you're like a call contract and you need some clarification. You can not suggest as add a comment and be like is this a contract uh, uh, like say for sale or like whatever kind of clarifying questions that you're kind of a little fuzzy on. By all means, like they're my philosophy is yes, there are stupid questions, and I do want as your tutor for you to ask them to me because that's how you learn.
Perfect. Yeah, because I got a lot of stupid questions.
Yeah, there you go. Yeah, send them over. So, but yeah, you can put them on as comments here, and just feel free to have that at the ready. Also, like more and more self learning for anybody. My tutorial, though I'm posting it on YouTube, it's probably not going to be the best one out there. It's just like the most quick and simplified, and pointing out the things that usually seem misunderstood first and foremost, in the simplest and fastest way that I could write them out. Um, so yeah, so by all means, just you can comment and we'll give it another try. There's other people that said they wanted to do this with me as well, so hopefully they will be ready to set up and show up to the next one we do.
Yeah, like man, dude, I'm like cheese, like got a cheese grin, but like this is fun. I'm enjoying it. Enjoying figuring it all out.
All right. So I'm going to go ahead and end the recording. Bye, folks at home.